Hello and welcome back. All right, we are doing a slight pivot now, staying with the theme of growth, but we're going to start to look at more traditional growth. I'm done with hypergrowth. That's the phrase I use for high growth. I mean, there's no hard and fast rule for high growth, but I don't know. I tend to think of growth rate higher than 15% a year. I think if you get much below 10%, I consider that kind of traditional growth, as we'll see. Now, the key emphasis when I talk about growth, particularly when we talk about market implied growth, which it's NOPAT growth, it's the growth in NOPAT. And this is an important subtlety because it's not just revenue growth, because NOPAT is a function of revenue and margin. And so if margins expand, that will accelerate your growth rate. And if you have revenue growth and margin expansion, obviously you're going to have NOPAT growing faster than the revenue growth. And I think that's what's important. So this lecture, I'm really going to talk about the impact of margins and changes in margins. And then in the next lecture, I'm going to start to build up the next lecture is going to be called modeling growth. We're going to start to build start to think about growth in a systemic way, kind of from a model perspective. And then the lecture after that, we're going to use that construct of thinking about modeling growth, modeling traditional growth, and then we'll use that to model a company, a theoretical company. And then from there, we'll start to apply that to real companies. All right, so might as well get started. All right, so the key here is it's market implied NOPAT growth, not just revenue growth. Most of the time when investors talk about growth, they tend to focus on overall revenue growth, but it's really important to understand that this is profitability. Valuation is dictated by the cash flow that companies generate, and therefore, and I like NOPAT as my proxy for operating cash flow. Therefore, what we care about is growth in NOPAT. All right. Now, I introduced when we were in valuation 2 ways to calculate the market implied growth rate as opposed to the market implied value of growth, 2 different things. Obviously, they're connected. And I don't know, I guess in a sense they look intimidating, but the growth rate can be calculated one of 2 ways. There are 2 formulas. One is you can take the market implied value of growth, that's that green area in all the charts I've been using, divide that by the enterprise value, and you're creating the market implied value of growth as a percentage, and then you multiply that by your discount rate, and that is your implied long-term NOPAT growth. I mean, this to me is so simple and so beautiful and so elegant and so true that I really love it. Because if you take market implied value of growth as a percentage of enterprise value and then multiply it by a discount rate, that's an easy calculation. And that's your long-term NOPAT growth rate. The other way you can calculate it, get the exact same answer, is you can take your discount rate and subtract off what is your NOPAT cash yield. That's NOPAT divided by enterprise value. So if you bought the company, any company, at its enterprise value, and you took the NOPAT and you could pay yourself that NOPAT every year, that would be a NOPAT cash yield. And if you take the discount rate and you subtract off your NOPAT cash yield, that's your long-term NOPAT growth rate. So both formulas work. Interestingly, I generally use the first formula when I'm looking at companies. Today, we're going to use the second formula to think about changes in margin. All right, so that's the first formula I tend to use. All right, and this is for Chipotle. I just calculated this a week ago. This is through the end of calendar 2024. Obviously, they just reported. And the green area is your market implied value of growth. And that's a percentage, and that is the left scale. And then you can calculate, I'm just using 10% as my discount rate to make the math easy. Use whatever you like, although don't get too worked up about it. And this will just show you the market implied NOPAT growth rate, perpetuity growth rate. And right now it's about 7.9% for Chipotle. It's been kind of in the 8 to 8.5 for a while. In 2020, when we had big valuations, it got up to 9.5. But if I look over the last 8 years or so, high 8s, low 9s, it's the lowest we've seen. The market implied value growth right now, this is as of last week, is the lowest we've seen since 2017 when they were still recovering from the norovirus food safety issue, which I think is interesting. Investors right now are betting that the growth rate at Chipotle is slowing down, for what it's worth. All right. And that's really the focus of today's lecture, of those numbers. All right, so let's talk about NOPAT growth. Now, NOPAT growth, you have to start at the top unit. You have to talk about revenues. All right, so NOPAT growth, we're going to start at the revenue line. Now, revenue is obviously a function of units and price. Historically, we could kind of ignore changes in price in this equation because we had very little inflation. That's changed in the past couple of years. I'll talk about that in a minute. All right, so let's start with unit growth. Unit growth for a company is equal to industry growth plus or minus changes in market share. This is a really important, subtle comment that the company's unit growth rate is going to be a function of the industry growth rate plus or minus changes in market share. All right, important. So the only way for a company to grow faster than the industry is to capture additional market share. Right? Just falls out. So anytime a company says they're going to grow faster than the industry growth rate, they are basically saying they're going to take market share away. Now, the fun part about being an analyst is all of the companies in the industry believe they're going to grow faster than the industry, which I think is hilarious. Now, maybe the industry growth rate's too low or something, but obviously not everybody in the industry can grow faster than the average. That's pretty straightforward. And so if a company claims they're going to grow faster than the industry, they're effectively claiming they're going to gain market share, unit market share. And I think it's really important as the analyst, investment analyst, to be able to explain how the company is gaining market share. And the subtleties here are not insignificant. And it's very hard to gain market share in a high return business. Why? Customer captivity. That's simple. High return businesses have customer captivity by definition. That's what makes them high return businesses. So if that industry is going to maintain its high returns, return on capital, it's got to maintain its customer captivity. And customer captivity is the opposite of market share gains. I get arguments from investors, portfolio managers, students all the time about this. It's just straightforward. It is almost impossible to gain market share in an industry that has customer captivity. By definition, the best businesses have customer captivity. I don't think there's anywhere else to hide. All right. Now, however, because many companies attempt to deliver growth greater than their industry growth rate, they enter into a growth trap, which I think is a really important comment. And a growth trap is defined as continued revenue growth, but declining profitability, right? Expenses are growing faster than revenue as management chases growth. That incremental growth, that incremental market share the company's trying to capture becomes increasingly expensive. Those incremental customers are hard to get. They're very expensive. So the growth trap is a company trying to gain market share, probably in what historically has been a great business, a great industry. But because of customer captivity, it's very expensive to get customers to shift from one vendor to another. And therefore, your expenses, these companies' expenses, grow faster than their revenue. So that's, to me, definition of a growth trap. Watch for that. All right. Here is retail sales, U.S. retail sales annually. And I just put a little table together, Walmart, Sam's. I know they're owned by the same company, two different formats, Costco, Target, and Best Buy. What I've done is line up their U.S. retail sales on a calendar basis. All of them have slightly different fiscal years. I've just done that. I've calculated down at the bottom a market, consider it sort of a representative market, total revenue for all of the companies. And then you can calculate market share of that. And so the first line for Walmart is their annual revenues, U.S. retail sales only. The line below that is their share of the market that's made up of Walmart, Sam's, Costco, Target, and Best Buy. The next one, Sam's Club, same company, different format. That's their annual revenues. The line below that is percent market share, and on, and down the table. All right, here you go. Here's Walmart's relative market share from 2012 to 2023, 11 years. Their market share relative to these primary competitors went from 52.5% to 51.7% over 12 years. Sam's Club went from 10.8% to 10.1%. Target went from 13.8 to 13.7. And then in the last 2 years, they've actually lost a little bit of share, which is interesting. Look at this. Costco has actually gained market share relative to their direct competitors, primarily because of the superiority of their platform. So and I think I have one more. Yeah, and you can see Best Buy has lost market share. So market share does move around, but not nearly as much as people think. Base rates. Start with the industry growth rate and then go from there. If you think the company can gain market share, then it is possible that they can grow faster than the industry. We saw that with Sam's Club, grew faster. We saw that with Best Buy, grew less fast. They have been disintermediated. Now, I don't have Amazon on here on purpose. I just wanted to show you relative share among traditional vendors. All right. And here is just the chart so you can just take a look. You can see that Walmart gained some share early on in the chart and then lost some of that share. And that's kind of the ebbs and flows every year. Costco has gained a share. Best Buy has shrunk their share. Sam's Club and Target have, again, you lost a little bit of share to Walmart, gained that back. But over time, it tends to be fairly steady. It's important to keep in mind. All right, and there's just the trends. All right, so now revenue growth is unit growth times changes in prices. Now, as I said moments ago, we could cheat. Could cheat for the last couple of decades. We had almost no changes in prices. A lot of deflationary pressures, deflationary product pressures over the last couple of decades. That's changed recently where pricing has been infected by inflation. Looks like inflation's coming back. We'll see what sort of economic policies that actually do get implemented by the new administration, but we do now have to think about prices in a way we never had before. Do keep in mind that what you care about is changes in prices versus changes in costs, because the changes in prices and changes in costs are parallel. There's going to be no change in overall margin. All right, next, NOPAT growth is clearly revenue growth times changes in NOPAT margin, and that's really the setup. So if you believe the company's margins, NOPAT margins will stay steady over time, then guess what? Their NOPAT growth will equal their revenue growth. But if you think that there are going to be changes in NOPAT margin, you need to take that into account. What I'm going to do in my example in a minute, I'm going to talk about a more extreme example where it's kind of recovery margins or a big expansion in margins, not a small expansion in margins. So we'll see. Let's focus on NOPAT, changes in NOPAT margin. All right, these are the two formulas I talked about before. We saw that earlier in the lecture. I'm going to focus on the second one. It's just easier to use. All right, so we know that growth equals NOPAT, the discount rate minus your cash yield, NOPAT divided by EV. So the growth rate today at time is 0. That's growth rate at t equals 0. Clearly is NOPAT margin at time t0. That's how we calculate the growth today. So that's your market-implied NOPAT growth today, t equals 0. All right, now the question would be is what do we have? What we care about is revenue growth because that gives us the basis of looking at the industry. So we need to kind of work backwards and figure out what is the implied revenue growth rate if we think margins are going to change. All right, so here we go. The market-implied revenue growth equals the market-implied NOPAT growth if margins do not change, as we see in this equation. All right, but if margins do change in the future, and what I'm doing here is really looking at 2 points today and sometime in the future, and rather than have margins change every year, because margins have a limit. They can only change so much one way or the other. Let's pick 2 time periods today and then a year from now, 2 years from now, or 3 years from now when you think the new margins will expand. So let's pick the margins from today, margins from in the future, that change in margins, and then we can calculate back what the market implied growth rate, revenue growth rate is. Okay, great. All right, so here's the formula. It looks a little intimidating, but basically the market implied revenue growth rate in the future, GT equals 1, is equal to today's market implied growth rate, and then this ratio. And the ratio is just capturing changes in margin. Ignore the formula for a moment. You can work through it. It's actually very simple once you play with it. EV doesn't change. R doesn't change. The only revenue doesn't change. It's the margins changing. So all you have to do is change the 2 margins. which I'm going to do momentarily, and you can see how that affects your growth rate. That leftover, that residual growth rate, is revenue growth rate. I'm sure I've lost some people already, so let me pause for a moment. All right, so if we look at the top of this page, the growth rate today is a NOPAT growth rate. But if I think margins are going to expand over the next couple of years, I want to see what the market implied revenue growth rate is. That's what I'm trying to calculate. So what I do is I take today's margins, calculate what the market implied NOPAT growth rate is. I then expand my margins 3 years out in this example. I calculate what the implied market implied growth rate would be at those higher margins. And then that effectively is your market implied value of revenue growth, And so that's what I'm walking through. All right, so we can determine the market implied revenue growth rate after the margins have changed. That's the key. All right, so here's the example. So I have revenue today of 100 million, NOPAT margin of 10%. NOPAT would then be $10, 10 million, whatever it is. All right, cost of capital is 10%. So the earnings power value, that light blue that we've been using throughout the lecture series, would be 100. Your market implied value of growth is 300. Enterprise value is 400. All right, your market implied value as a percentage of EV is 75%. So if I use 10%, we know that the market implied NOPAT growth is 7.5%. But what is the market implied revenue growth? I want that market implied revenue growth because that's the growth rate I'm going to compare to the industry. All right, now, if your NOPAT margins are not going to change, then your market implied NOPAT growth is equal to your market implied revenue growth. There's no change in margins. All right, so that's easy, right? We take 100 times 10%, we get $10 in NOPAT. We take that 10 million, or 10, whatever the units are, we divide it by 10%, we get the earnings power value of 100. The market implied value of growth is the difference between the enterprise value and the earnings power value. All right, this is how it looks graphically. What do we have? We have earnings power value is 400. Enterprise value is 400. Earnings power value is 100. Market implied value of growth is 300. All right. Now, that's that 75%, right? Let's just change it. So today, exactly the same chart, but I'm saying 25% of today's value is earnings power value. 75% is market implied value of growth. That green represents investors' expectation for NOPAT growth. That's the present value of future NOPAT based on the growth. That's the growth component. We've captured it in our valuation. Okay, great. Now, what we want to try to do is, the formula, right, is the market implied value of NOPAT growth is equal to the market implied value of growth as a percentage times your cost of capital. I'm using 10% in this example. Easy. All right, so now let's say, so your market implied revenue growth equals your market implied NOPAT growth and no changes in margin. But we want to look at changes in margin. So here we go. Let's look at the higher margins. Let's say we believe the company can expand their margins from 10% to 15%. And we're going to use exactly the same P&L just to capture this. So revenues after the higher margins are still going to be 100 million. NOPAT margin is going to go from 10% to 15%. Your NOPAT's going to go from 10 million to 15 million on the higher margins. Cost of capital is the same, 10%. Your earnings power value now goes from 100 million to 150 million. Your enterprise value, let's hold constant at 400 million. That means your market implied value growth goes from 300 million to 250 million. Your market implied value growth as a percent of the enterprise value goes from 75% to 62%. So I'm going to walk this through again because I suspect some people are like, wait a minute, I'm lost. So I'm just saying, you believe, you estimate, you talk to management, you do your work, you believe the company's NOPAT margin is going to go from 10% to 15%. Now, people will say, well, wait. I think it's going to expand because they're going to grow revenues. They'll grow revenues faster than expenses. The margin will expand. I agree, but what I'm trying to do is just capture what is priced in terms of margin expansion versus revenue growth. So let's just take today and say that magically the company could expand its margins from 10% to 15%. We know that its earnings power value, the blue line, would go from 100 million to 150 million. If the enterprise value was the same, then the residual after the margin expansion would be a market-implied value of growth of $250 million. So effectively, the $300 million in market-implied value of growth today has $50 million. $50 million of that $300 million is effectively priced in for margin expansion, not revenue growth, right? We're looking at NOPAT growth. What drives NOPAT growth? Revenue growth and margin expansion. So what we've been able to tease out is the market-implied value of growth. That $300 million today has embedded in it margin expansion and revenue growth. And what we can calculate is, guess what? That the market-implied revenue growth is 6.25% a year, and you have a 50% increase in the margin expansion from 10 to 15%. Let me just show you, walk through it. Because I have the higher NOPAT, that earnings power value goes from 100 million to 150 million. My hold the EV constant, and then my market-implied value of growth is 250 rather than 300. That $50 million difference shifted from the market-implied value of growth to the earnings power value. Now, we can look at the business and say it has a 15% NOPAT margin. That's steady state. Now, when we calculate the market-implied value of NOPAT growth, we can calculate the market-implied value of revenue growth because it's going to be exactly the same as the NOPAT growth. So what I'm trying to capture is what is going to be the market-implied value of revenue growth after the margin expansion, and that's what we've calculated. All right, so let's go back to the chart. My earnings power value goes from 100 million to 150 million. My market-implied value of growth goes from 300 million to 250 million because of the margin expansion. And so now your market-implied value growth as a percent of enterprise value is only 62.5%, right? So market-implied value of growth goes from 75% to 62%. Now the 75% today, market-implied value growth, has two components, revenue growth and margin expansion. I want to tease out how much of that is margin expansion and how much of that is a market-implied value of NOPAT growth, which then, once the margins have expanded, we reach steady state, and now I have the market-implied value of NOPAT growth equals the market-implied value of revenue growth because margins will now be steady state. That's all I'm trying to capture. And so the market-implied value of NOPAT growth equals, as we know, 10 times 10%, your cost of capital times your market-implied value of growth percentage. All right, so this is what it looks like. So this is the key. Today, if I look at the enterprise value, 25% of the value is the current earnings power value with the current margins of 10%. It also has implied 12.5%, which is earnings power value with the margin expansion. So margin expansion is going to create 12.5% more earnings power value. So today, 62.5% is actual growth, revenue growth, unit growth. 12.5% is margin expansion, 25% is earnings power value. All right, that's the key. We've been able to tease that out. So today, the market-implied revenue growth is 6.25%, not 7.5%, because of the margin expansion. So we've been able to tease that out, and that's the key. So the market-implied value of revenue growth is 6.25%. All right, we are now at the end of the video, but I want to go back to this one more time so people have it. I am trying to capture here what is priced in. Now, I do know that 25% is the earnings power value. My assumption that that's your steady state value at today's operating margin. All right, I have today 75% then is market-implied value of growth. NOPAT growth. But in that market-implied value of NOPAT growth is margin expansion and revenue growth. I am just curious, can I tease out what is priced in for margin expansion and what is priced in for revenue growth? I'm trying to pull that apart. All right, so we do the math. We say today's operating margin is 10%. I think the operating margin in 3 years is going to be 15%. Okay, so I do that math. What if they expanded those margins to 15% today? Just curious. So that would increase my earnings power value from 25% to 37.5%, which would then mean that the green would be 62.5%. 62.5% times 10%, my cost of capital, is 6.25%. Now, I'm not looking for precision. So in the first model, it implied revenue growth of 7.5% perpetuity, no margin change. However, I expect margins to expand. Therefore, it's really 62% market-implied value growth, 6.2, 6.3, 6% growth rather than 7.5. So what's priced in is the margin expansion and 7%, 6.5% revenue growth. So now if I'm in an industry that's growing at 6.5 to 7%, in the first model, I am forecasting NOPAT growth with no margin expansion greater than the industry growth. Probably a bit concerned. It's like, the industry's growing 6.5, 7. This implied is 7.5%, maybe a bit more. That sounds tricky. However, then I say, well, wait a minute. Actually, they're going to be able to expand margins. And so once they've expanded their margins from 10 to 15%, I am getting an implied revenue growth rate of 6.2, 6.3%. Now I'm looking at a implied revenue growth of 6.2, 6.3% in an industry I believe is growing 6.5 to 7%. Now all of a sudden, I think the growth rate is understated because I have a lot of confidence they'll expand their margins. All right, some of you may decide to watch the video again. I know it's slightly complicated, but once you get your handle around this, it's actually kind of a cool way to think about changes in margin. Obviously, it works the other way. The big takeaway is if you think margins are going to expand, the implied NOPAT growth rate is higher than the required revenue growth rate. And that's important. We can do the math. We can figure it out. All right, in the next video, I'm going to start looking at how you model growth, and then we'll ultimately bring that all together and start to model companies. All right, thanks for watching.